The reform of China's macroeconomic situation has been signposted for some time. We heard in the third plenum that those changes will be accelerated over the coming years. In particular, interest rate reform will be accelerated. We'll see acceleration of renminbi internationalisation, as well as other regulatory reforms which impact private companies versus state-owned companies. All of those changes have implications for banks, and they're having to respond strategically by accelerating their own transformation. And so those changes create both opportunities as well as challenges. Historically, China has had a managed interest rate environment. One of the last pieces of that is the cap on deposit rates, the maximum deposit rate. And that's the last piece to be lifted. As that is progressively lifted, banks will be subject to more competition in how they obtain their funding sources, and that will push up their cost of funds and put pressure on their margins. So banks have different ways of responding to this pressure. Many of the domestic banks will be looking at broadening their offering to customer segments that have previously been underserved, where they can expand their margin, in many ways taking more risk whilst at the same time managing that risk. Other institutions will be focusing on managing the consequences of that change. So, for example, one of them, which is often underestimated, is the impact of interest rate liberalisation on liquidity. As market pricing is used for pricing the liabilities, that makes them more volatile. And many banks, particularly smaller ones with either lumpy portfolios or larger ones that are subject to large mismatches, are having to relook at the way they manage their liquidity in an interest rate deregulated environment. As a result, that has short-term implications for the way the extent of liquidity risk that they take on, the mismatch that they run. And in the medium term, it has opportunities for them to manage their liquidity by focusing on products which help their behavioralization of their maturities and help to create, if you will, more sticky deposits. And that's something that we're seeing a lot of interest in amongst Chinese institutions in the last 6 or 9 months, who are keen to make both short-term changes in their governance of liquidity, but also longer-term changes to their strategy to take advantage of the new market environment that they'll see over the next couple of years. One of the other regulatory changes that we see is internationalisation of the renminbi. And this creates a number of opportunities for domestic banks and foreign banks. Probably the biggest winners of this will be foreign banks with offshore capabilities, able to service offshore clients who traditionally would have remitted payments in US dollars and who are now switching to renminbi. Those with a base both on the mainland and a strong international network and a good product offering will be able to service that settlement demand. And over time, as the offshore renminbi market, the desire to invest renminbi offshore increases, they'll also be able to leverage that network and that capability to develop renminbi-based product. So foreign banks are looking at this area with a great deal of interest. And the Shanghai Free Trade Zone pilot, also they're looking at, in the context of renminbi internationalisation, they're looking at using that zone as a way ultimately of channeling funds back into the market. As we stand at the moment, that pilot free trade zone doesn't allow that money to be lent outside of the zone itself, but there is some hope and expectation that over time that will happen. And at that point, the internationalisation of the renminbi and the foreign banks have a significant opportunity and competitive advantage. I think banks can look at the strategic options in 3 main areas. Firstly, in terms of their customers, the regulatory changes that we've been talking about create new customer demand These are in sectors, for example, such as privately owned enterprises. As China rebalances the focus from state-owned to private, the private sector will be net beneficiaries in terms of their demand for credit and also other services. And so banks are refocusing their focus on that sector. They're also looking at other geographical markets which perhaps previously would have been off their radar screen. So the customer is the first area. The second is in relation to products and product offerings. Regulatory reform is creating opportunities for certain areas which, again, previously weren't really priorities. So in our surveys, it highlights the demand or the desire to grow areas such as wealth management, intermediary business, so investment banking in terms of bond issuance and commercial paper underwriting are significant product opportunities. And then perhaps the third area of strategic opportunities in relation to internet and digital, where again we see a significant degree of interest, both as a threat from non-bank institutions moving into the banking space, but also the banks themselves responding to that by partnering with technology and internet-based companies and to use it as a channel and as an effective channel to expand their marketplace in a cost-effective way. We believe that the long-term opportunities that are created by the regulatory reforms that we've seen create significant opportunities for banks. Foreign banks are particularly excited about the opportunities that it creates in areas that have previously been off limits, and domestic banks themselves, while seeing short-term challenges, understand the importance of those changes, and also within those changes see areas for them to develop new customer, product and distribution segments. So by and large, most people see the changes as both necessary and exciting in terms of the strategic opportunities that it opens up that previously weren't available.